Good afternoon, class. In this lecture, I'll provide an overview of the consolidation process and present the acquisition method of accounting for business combinations. So Chapter 2, Consolidation of Financial Information. So current accounting standards for business combinations. The FASB Accounting Standards Codification contains the current accounting standards for business combinations under the following topics. Business combinations topics 805 and consolidation topic 810. The two topics 805 and 810 provide guidance using the acquisition method. The acquisition method embraces the fair value measurement for measuring and assessing business activity. So learning objective 2.1, discuss the motives for business combinations. So in discussing the motives, we wanted to define a business combination. A business combination is the formation of a single economic entity, an event that occurs whenever one company gains control over another. So reasons for firms to combine. No two business combinations are exactly alike, but they share one or more of the following characteristics that potentially enhance profitability. And so here's a list of reasons why they may combine: vertical integration, cost savings, quick entry for products into the market, economies of scale, more attractive financing opportunities, diversification of business risks, business expansion, and increasing competitive environment. Here you have recent notable business combinations that some of which we should be aware of. You have Facebook, who acquired WhatsApp for $17.2 billion. AT&T acquired DirecTV for $47.4 billion. Berkshire Hathaway acquired Precision Castparts for $32 billion. So learning objective 2.2, recognize when consolidation of financial information into a single set of statements is necessary. So when should you combine them? So why consolidate financial information when two or more companies combine to create a single economic entity? Well, according to the FASB, consolidated financial statements provide more meaningful information than separate statements. Consolidated financial statements more fairly present the activities of the consolidated companies. And consolidated companies may retain their legal identities as separate corporations. To explain the process of preparing consolidated financial statements for a business combination, we address three questions. How is a business combination formed? What constitutes a controlling financial interest? And how is the consolidation process carried out? Learning objective 2.3, define the term business combination and differentiate across various forms of business combinations. And so here, a business combination refers to a transaction or other event in which an acquirer obtains control over one or more businesses. It is formed by a wide variety of transactions or events with various formats, can differ widely in legal form, and unites two or more enterprises into a single economic entity that requires consolidated financial statements. So types of business combinations, you have statutory mergers. So a statutory merger, any business combination in which only one of the original companies continues to exist. The two types of statutory mergers are a business combination in which one company obtains all of the assets and often all the liabilities of another company, or a business combination in which one company obtains all of the capital stock of another company. The acquiring company must gain 100% control of all shares of stock before legally dissolving the company. And so this would be an example of if Facebook, since they acquired WhatsApp, if they decided to create a whole nother, or if they decided to put WhatsApp consolidated into Facebook, and so WhatsApp never exists for going further, and you just have Facebook. So any business combination in which only one of the original companies continues to exist. So currently you have Facebook and WhatsApp, and then you end up just having Facebook. Types of business combinations, other models. So statutory consolidation, a specific type of business combination that unites two or more companies under the ownership of a newly created company. Two or more companies transfer either their assets or their capital stock to a newly formed corporation. Control with, dealing with statutory consolidation. So basically you have two companies. If you had Facebook and WhatsApp, and then they decided to create a third company just call it Messenger or X Messenger or something, and now you no longer have Facebook and you no longer have WhatsApp. Now you have the new company called Messenger. And so a specific type of business combination that unites two or more companies under the ownership of a newly created company. So control without dissolution. When one company achieves legal control over another by acquiring a majority of the voting stock, although control is present, no dissolution takes place. Each company remains in existence as an incorporated operation. So in this instance, that would be as if Facebook and WhatsApp just continue to operate independently, but Facebook controls WhatsApp. Some additional type of business combinations: variable interest entity, a VIE. Variable interest entities, a vehicle for control exercised through contractual agreements with a sponsoring firm that may not own the VIE, but becomes its primary beneficiary with rights to its residual profits. Contract forms include leases, partnership rights, participation rights, guarantees, other interests. Criticized in the past for providing sponsoring firms with off-balance sheet financing and sometimes questionable profits. Current GAAP expands the notion of a control and thus requires consolidation of VIEs by the primary beneficiary. Formats of business combinations. So Exhibit 2.2, business combinations, is an illustration of the type of combinations, the action of acquiring company and the action of acquired company. And so the first one, statutory merger through asset acquisition, acquires the action of the acquiring company acquires assets and often liabilities, and then the action of the acquired company dissolves and goes out of business. Another example is a statutory merger through capital stock acquisition. Actions of the acquiring company: it acquires all stock and then transfers assets and liabilities to its own books. The action of the acquired company dissolves as a separate corporation, often remains as a division of the acquiring company. And so of course, the action of the acquiring company. This is the company that is purchasing or gaining the other company, and then the acquired company is the company that's being gained or that's dissolving. So, as an example, the acquiring company will be Facebook, and the acquired company will be WhatsApp. The FASB control model. So FASB ASC A10-10-15-8 provides guidance and describes control as follows. The usual condition for a controlling financial interest is ownership of a majority voting interest, and therefore, as a general rule, ownership by one reporting entity directly or indirectly of more than 50% of the outstanding voting shares of another entity is a condition pointing toward consolidation. Consolidation of financial information. So when one company gains control of another, a business combination is created, and a single set of consolidated financial statements must be prepared. So now we've gone over the business combination and the control, and now it's the financial statements. Number one, parents and subsidiary financial data are brought together. Number two, financial position, results of operations, and cash flows are reported by the combined entity. And number three, reciprocal accounts and intra-entity transactions are adjusted or eliminated to ensure reported balances represent a single entity. So what is to be consolidated and when? So if a dissolution occurs, all appropriate account balances are physically consolidated in the financial records of the survivor. The permanent consolidation occurs at the combination date. If separate incorporation is maintained, only the financial statement information on work papers, not actual records, is consolidated. The consolidation process is carried out at regular intervals whenever financial statements are to be prepared. And so under the first one, that would be an example of a statutory merger. The second one would be this statutory consolidation. If dissolution occurs, dissolved companies' records are closed out. Surviving companies' accounts are adjusted to include appropriate balances of the dissolved company. If separate incorporation is maintained, each company continues to retain its own records. Worksheets facilitate the periodic consolidation process without disturbing individual accounting systems. Learning Objective 2.4, describe the valuation principles of the acquisition method. The acquisition method. The acquisition method is required to account for a business combination. It embraces the fair value in measuring the acquirer's interest in their acquired business. So applying the acquisition method involves using fair value to recognize and measure the consideration transferred for the acquired business and any non-controlling interest, separately identified assets acquired and liabilities assumed, goodwill or gain from bargain purchase. Fair value. GAAP requires that the fair value of assets acquired and liabilities assumed in a business combination be determined at the acquisition date. And so basically, most times companies carry their assets at a book value, and so fair value would be the going rate at that given date and time. And they're going to give you some further definition of that. Fair value, the price would be received from selling an asset or paid for transferring a liability in orderly transaction between market participants at a measurement date. Valuation techniques. So ASC 820-10-35-28 identifies 3 valuation techniques. The market approach estimates fair value using other market transactions involving similar assets or liabilities. The income approach relies on multi-period estimates of future cash flows projected to be generated by an asset. And the cost approach estimates fair values by reference to the current cost of replacing an asset with another of comparable economic utility. So basically, these are 3 different types of techniques to put value to the asset that you're obtaining from the company here and applying the fair value. So goodwill and gains on bargain purchases. So what if the consideration transfer does not equal the fair value of the assets acquired? So if the consideration transferred exceeds the net amount of the assets acquired and liabilities assumed, the difference is attributed to the asset goodwill by the acquiring company. So basically they're saying the amount that you paid for the company, when you look at the actual net value, the fair value of the company, you paid more than what it's worth. And that could be possible, and what it would be attributed to is goodwill, the difference. If the value of the assets acquired and liabilities assumed exceed the consideration transferred, a gain on bargain purchase is recognized by the acquiring business. So here you purchase the company for less than what it's valued at, and it's considered a bargain purchase. Learning objective 2-5, determine the total fair value of the consideration transferred for an acquisition and allocate the fair value to specific subsidiary assets acquired, including goodwill, and liabilities assumed or to a gain on bargain purchase. So here is going to be, this is an example. So consideration transferred equals the fair value of net assets acquired. So here, what you paid for the company equals the value of the company. So assume that BigNet agrees to pay cash of $550,000 and to issue 20,000 previously unissued shares of its $10 par value common stock, currently selling for $100 per share, for all of Smallport's assets and liabilities. Following the acquisition, Smallport then dissolves itself as a legal entity. The consideration transferred from BigNet to Smallport exactly equals the collective fair values of Smallport's assets less its liabilities. So here, what they end up paying for the company is around $2,550,000 because the 20,000 shares they're issuing at $100 a share. So that's $2 million. Even though, do remember on their books, they're going to recognize that at around $200,000 because the par value was $10. So procedures for consolidating financial information. So the 2.5 million fair value of consideration transferred by BigNet equals the collective fair value of Smallport's assets less liabilities and serves as a basis for recording the combination. So here they prepared a schedule, and they basically have the accounts, the subsidiary accounts and activity for BigNet company. They have Smallport company. They have their book value, and then they have their fair value. And so what ends up happening at time of acquisition, you go back and find the fair value for these items that are on their books at a book value. And so the $300,000 remain the same for current assets. they adjusted upwards for the computer and equipment, which they could have used a replacement price, things of that nature, those three types of valuation techniques. Same thing for the capitalized software. And then customer contracts were added up for $700,000. They also determined they had $50,000 more in notes payable at the time. So the company's balance worth ends up being $2.5 million to $2.55 million, which is equal to what Big Net paid for the company. So procedures for consolidating financial information. So legal and accounting distinctions divide business combinations into separate categories. Various procedures are utilized in this process according to the following sequence: the acquisition method when dissolution takes place, and the acquisition method when separate incorporation is maintained. When an acquired firm's legal status is dissolved in a business combination, the continuing firm owns the former firm's net assets. So acquisition method when dissolution takes place. The continuing firm prepares a journal entry to record the fair value of the consideration transferred to acquire the dissolved firm, identifies assets acquired and liabilities assumed at their individual fair values. The entry to record the fair value of the combination depends on whether the consideration transferred is equal to, exceeds, is less than the fair value of the net assets of the firm dissolved. So here, where they just discussed the journal entry, you're going to actually prepare one. So prepare the journal entry to consolidate the accounts of a subsidiary if dissolution takes place. And so I brought the financial information in again, so you'll be able to view it to see the information that you're going to need to make this journal entry. And so the journal entry is as follows. Under the acquisition method, Big Net requires Smallport's assets and liabilities at fair value, ignoring original book value. Revenue, expenses, dividend, and equity accounts cannot be transferred to a parent and are not included. So when you look back at the information, that's this information here from Smallport Company. So now for current assets, so the journal entry for the acquisition. So current assets is a debit for $300,000, computer and equipment for $600,000, capitalized software for $1.2 million, and the customer contracts for $700,000. If you look back at your information, these are the assets that you're doing a journal entry for right here. These items here. Now the journal entry further, the $250,000 for notes payable, which is here, is a credit. So now you have the actual acquisition activity where they paid $550,000. So that's going to be cash paid by Big Net, which is a credit, and then you have the $200,000, which is the issuance of the common stock, 20,000 shares issued by Big Net at $10 par value. And then the additional paid-in capital recognizes the fair value. They were sold for $100, which was $2 million. So the difference between the $200,000 and the $2 million is the $1.8 million for the additional paid-in capital. So to record acquisition of Smallport Company, assets acquired and liabilities assumed are recorded at fair value. That's your journal entry description. So consideration transferred. So when the consideration transferred exceeds fair value of net assets acquired and liabilities assumed. So here, this is where you're overpaying. So Big Net transfers to the owners of Smallport consideration of $1 million in cash plus 20,000 shares of common stock with a fair value of $100 per share. So that's $3 million. So the $3 million consideration transferred from Big Net to Smallport results in an excess amount exchanged over the fair value of the net assets acquired. When the consideration transferred in an acquisition exceeds the total net fair value of the identified assets and liabilities, the excess, the $450,000 in this case, is allocated to an unidentifiable asset known as Goodwill. So here, again, the journal entry to record the acquisition resulting in Goodwill this time. So you have the $3 million. So here you're going through the same assets and liabilities: $300,000, $600,000, $1.2 million, the $700,000. The notes payable is a liability. You issue, instead of the stock issuance was the same, the $200,000 and $1.8 million. Your cash was more, so it increased, so it's $1 million, and so the offsetting difference is the $450,000, which would be a debit to Goodwill. So again, this is when the issuance exceeds the fair value of the company. You're going to recognize the difference in goodwill. So consideration transferred is less than identified assets fair values. So an exception to the general rule of recording business acquisitions at fair value of the consideration transferred occurs in the rare circumstance of a bargain purchase. Bargain purchase, the fair value of the consideration transferred by acquirer is less than the fair value received in an acquisition, which is considered more relevant for asset valuation than the consideration transferred. So here, Big Neck transfers consideration of $2 million to the owners of Smallport in exchange for the business. Big Neck conveys no cash and issues 20,000 shares of $10 par common stock that has $100 par share fair value. So here, there's no cash. All they did was issue the stock, and they only paid $2 million. And we know the company is worth $2.55 million. So there's going to be a difference. Again, you record the same assets, same liability. When they issue the $2 million in common stock, you have the issuance of the stock at $10 par, which is $200,000. The additional paid in capital is $1.8, and now you have an entry for the $550,000 on a gain or bargain purchase credit. So instead of goodwill, you're going to have a gain on bargain purchase for $550,000, and it says to record acquisition of small port company, assets acquired and liabilities assumed are each recorded at fair value. Excess net fair value is attributed to a gain on bargain purchase. Learning objective 2-6B, prepare the journal entry to record the various related costs involved in a business combination. So now you have some costs that are going to be involved. Lawyer costs, accountants costs, things that help you carry out the combination. And so 3 additional categories of costs are incurred in business combinations, regardless of whether dissolution takes place. So these are the related costs of business combinations. You have 1, attorney, accountants, investment bankers, and other professional engagement for the combination-related services. These services are expensed in the period incurred. Then you have an acquiring firm's internal costs, like secretarial management time allocated to the acquisition activity. Such indirect costs are reported as current year expenses too. Then you have amounts incurred to register and issue securities in connection with a business combination, simply reduce the otherwise determinable fair value of those securities. And so now you're going to have an example. So journal entry to record related costs of business combinations. So regardless of whether a dissolution occurs or separate incorporation is maintained, BigNet records these transactions as follows. So these expenses are recognized regardless of whether or not the company dissolves itself. So BigNet company's financial records. So for the professional service expense, they're going to debit the professional service expenses and they're going to credit cash for $100,000. That's lawyers, accountants. And it says to record expense of the current period of any direct combination costs. So now you have the administrative costs, salaries and administrative expenses. That's going to be a debit to salary and administrative expenses and a credit to accounts payable or cash, depending on how it was paid out. And to record expense of current period, any indirect combination costs. So these are the indirect costs. So lastly, you're going to have additional paid in capital debited for the $20,000 and a credit to cash for $20,000 to record the cost of registered issuance of stock in connection with the small port acquisition. Learning objective 2-6C, prepare the journal entry to record a business combination when acquired firm retains its separate existence. So the acquisition method when a separate incorporation is maintained. Significant differences are evident in the combination in which companies remains a legal incorporated separate entity. Consolidation of the financial information is only simulated. Acquiring companies does not physically record the acquired assets and liabilities. Dissolution does not occur. Each company maintains independent record keeping. To facilitate the preparation of consolidated financial statements, a worksheet and consolidation entries are employed using data gathered from these separate companies, although neither company ever records consolidation worksheet entries in its journals. So basically, because it's not dissolved and it doesn't it's going to remain separate on its own. When you're doing these journal entries at the end of the year, they're only simulated and they're only for presentation purposes. So that means no journal entries will be done. So BigNet acquires Small Port Company on December 31st by issuing 26,000 shares of $10 par value common stock valued at $100 per share. BigNet pays fees of $40,000 to a third party for its assistance. BigNet promises to pay an additional $83,200 to the former owner if Small Port earnings exceed $300,000 during the next annual period, with an expected present value of $20,000 for the contingent liability as shown below. And so the additional performance incentive is an add-on to this problem. And so here at the bottom, the fair value securities issued by BigNet was $2.6 million. That's the 26,000 shares at $100 a share. And then they're telling you they had an additional $20,000 contingent liability based on the performance promise. And so altogether, the total fair value of consideration transferred is $2,620,000. So when the subsidiary remains separate, the parent establishes an investment account that initially reflects the acquired firm's acquisition date fair value. Because Small Port maintains its separate identity, the BigNet prepares the following journal entries on its books to record the business combination. And so BigNet Company financial records, December 31st, investment in Small Port Company consideration transfer was $2.6 million. The contingent performance liability was $20,000. The issuance of stock, the $26,000 shares by BigNet at $10 par value, and then the additional paid-in capital was the excess of those shares from the $2.6 million subtract the $260,000. And so this entry is to record the acquisition of Small Port Company, which maintains its separate legal identity. So it's just recognizing it as an investment, a $2.6 million investment. Then you had the additional professional service expenses, which a debit to a professional service expense and a credit to cash. So here there is no entry for liabilities for the assets individually for the notes payable. None of that. You're just recognizing an investment.